Well, coming out of a long three-day weekend and into a new week, you're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia and Nigel. Guys, hi, morning.
Hi,
morning.
Good morning. Back after a long weekend and heading straight into earnings season. So it's going to be a rough one, right? But another long weekend coming up.
Yeah,
so
that's
that's something to look forward to, perhaps.
The Friday's off as well. So 4-day weekend. We're getting used to it, right? I mean, spoiling our habits.
Yeah.
So when we have to actually go back to the grind, the full 5-day weeks, I don't know how we'll take it.
I think there's another one coming up in May, right?
Yeah.
The 1st of May, right?
1st of May.
Yes. So this week we have 4. Next week we have 5 days working, and the following week again I think we have.
I think we'll manage, right, Nigel?
all of us look really well rested. Just slept, relaxed.
Amazed.
All right, let's just quickly tell you what you need to know as we begin another trading session. So you got the US market data, which actually did not disappoint. I'm talking about the Friday's jobs report, and this is important because we had a string of data disappointments through the course of last week. Monday, Tuesday, Wednesday, ISM services, the ADP report, the Joel's number, they were all sober, and the market very aggressively started to price in much greater degree of Fed rate cuts later this year, and practically a pause in the month of May, which is the next Federal Reserve meeting. Friday was a departure because the jobs data was not super strong. It was not very hot, but it did not disappoint. It was in line and in some measure even beat expectations. And that's the reason why I'm saying this is something to note. The May FOMC pricing, in terms of what the market thinks the Fed will do in the month of May in its meeting, moved up. Pre-payrolls, it was about 11 basis points. It's now 18 basis points. This is market pricing, which means, you're basically back at looking at about a 25 basis point hike after the payrolls data. The market pricing of interest rates also has moved up. So, you had the 2-year, which is the most closely aligned to what the market thinks the Fed funds will look like, which had dropped to a new low of 3.65, new recent low of 3.65% earlier last week. It ended just under 4%. So you got a bit of a repricing which happened. Now the next data point, which is the CPI number in the US, is the other big thing to watch. So there's jobs and there's inflation. Jobs has come in line, and the CPI number on Wednesday I think will be the final, in a way, decider. If it is about 0.5% higher month on month core CPI, I think markets will stay put on that 25 basis point expectation. If it is a big disappointment, I think you can see fireworks, but that's Wednesday. Now coming to the market here, last 5 sessions, we basically had about a 650 point move on the Nifty and 1500 point move on the Nifty Bank. That's about 4% on each of these indices. The small cap index, by the way, in the same period, in the last 5 sessions, is up 6%. And the mid-cap index is up some 3% or so. So the broader markets, especially the smaller cap universe of the market, has done much better. But the Nifty and the Bank Nifty have done 4%, which is not bad at all. 5 sessions is what we're talking about. Most economists, the big news flow on Thursday, the last trading session, was the RBI's non-hike actually. And most economists now believe that the RBI perhaps is onto a extended pause. They may hike if CPI surprises. If growth slows down, perhaps we're looking at a cut as well. For the market here, it's not exactly a negative picture at all. You got constructive data points. Global markets are looking much better. The RBI has gone on a bit of a pause. Unless we see a big negative daily close, the trend for now remains higher. I said this on Thursday evening as well. For the Nifty, 17,615 is the level to watch. We're there. We opened much above that with about a 40-50 point adjusted higher close on the SGX. 17,615 is the 38% retracement of the entire fall. We breached that higher on Thursday by about 25 points. The high on Thursday was 17,640 or so. So that's the first one. And that, in a way, once we start trading above it, that becomes a bit of a support. 17,858 then is the 50% retracement of the entire fall from 18,887 levels, which is the all-time high. For the Bank Nifty, 41,200 is the first resistance, and 41,382 is the 50% retracement of the entire fall. These levels have not changed. Banks, by the way, underwhelmed as compared to the Nifty on Thursday. So we'll see. On the way down, the 40-day exponential moving average for the Bank Nifty stands at 40,519, and that's the level to protect on the way down if there are some jitters which start to come through. And of course, we are into the earnings season with this week with IT companies which will start to report. I mean, the street is divided, in terms of what will happen. Usually third quarter is the slow one, but this time many are saying that the fourth quarter, perhaps because of all that has been happening, maybe a little slow as well. Sonia.
Oh, absolutely. And I think that's the big focus area this week, right? You get into IT earnings with TCS coming up on the 12th. You have Infosys on the 13th. Then you have HDFC Bank on Saturday.
Yeah.
So I know it's not going to be a long weekend for a lot of people. There are a lot of numbers to track as well. But that's going to be the big focus area this week. And I think it'll be the first time that you will get an indication of what FY24 is going to look like. So there's an expectation that Infosys could come out with a guidance for FY24. And in that context, it's not expected to be a good Q4 for the sector because of the macro uncertainty, of course. But so Jefferies, for example, has said that Infosys could put out a 5 to 7% year-on-year guidance, constant currency revenue growth, and a 21 to 22% EBIT margin guidance. That's going to be the big focus area for the market, whether there is any more pressure expected in the IT numbers. And, a lot of these IT stocks have been going in on the back foot ahead of their numbers. They've been underperforming, so keep that in mind. For our markets, I mean, the trend is on the upside, no two ways about that. The Nifty is now up almost 4% from the 24th March low of 16,945. So in a sense, that has become the line in the sand, 16,900 thereabouts. And the Nifty is also above the 200-day moving average of 17,511. So in that context, a lot of levels were scaled up last week. The bulls have definitely tightened their grip on the market, and the FIs have also bought in cash for 6 straight days now. It was a small amount on Thursday, about 500 crores thereabouts. But in the last 6 trading sessions, FIs have put together bought almost 5,000 crores. So the going is good, but now everything depends on the IT sector and the tone of, the managements. So that'll be crucial. But otherwise, it's a market that the bulls have tightened their grip on. So I guess that's something that can continue.
Well, that's right, Sonia. The Nifty is trading a little bit at the higher end of the band. You look at the band on the downside, 17,200, and on the upside, 17,700, around 17,800. That level is likely to get met with some resistance out there. But we're still on a buy on dips mode till that 20 DMA or the 17,200, 17,250 gets violated on the downside. What's heartening, though, is the broader market performance. And as we pointed out last Monday itself, we're kickstarting a new fiscal. So the small caps, they could bounce back, small as well as mid caps. And the breadth of the market has looked quite good. You want to see more of the same, because otherwise portfolios, they got absolutely hit, towards the end of last fiscal. So good rebound, sustenance is key. What are the FIs doing in the F&O market? Well, they added some long positions, close to 2,000 contracts, and mild shorts is what they covered, close to around 1,000 contracts or thereabouts. That takes the positioning, the short positioning, to around 82% odd. So longs are around 18%, not as bad as the 91, 92% odd. So some part of that short covering has played out. On the option side, 17,600 call, 17,600 put. Both of them were very, very active in trade. So it appears there's a bit of a short straddle that's playing out. That's you write both these two strikes. You pocket a premium of around 190 to around 200 rupees odd. And you're bracing for that range of around 17,400 to around 17,800. If it stays in the range, you make money. But that's a strategy that's playing out. The crucial levels to track. 20 DMA on the downside, as I mentioned, that's an important mark to hold out. But the 50 DMA, that's the near-term level you should be looking at. So keep an eye out on that in terms of support zones. Resistance comes in at around 17,700. On the Nifty Bank, remember, it saw a big spike up post the RBI pause that we got in from the government, from the governor. But, the 50 DMA, that's important on the downside. The high that we saw before we went into this long weekend, that becomes a bit of a resistance at around 41,300 odd. If we can get past that, you'll want it to move to around the 100 DMA, which is at around 41,700 odd. So just keep an eye out on that mark. SGX Nifty, adjusted for it. It's indicating a bit of a positive start. My guess is don't go to chase the opening, but buy on dips is likely to continue with that 17,700 as a bit of a resistance zone.
All right, Nigel, let's quickly tell our viewers what's lined up in the first half hour of the show. We will get you updates from markets across the globe. Rajat Bhattacharya of Standard Chartered will join us to discuss the global trade setup. Later, our research team will, as always, get you CNBC TV 18's list of top 10 stocks for the day. At 8:30, we do a fundamental stock analysis with our market expert, Anand Tandon.
All right, we have plenty of market views coming up through the course of the next 2.5 hours, and some positive views as well. On the equities front, first up, we have Gautam Dugar of Motilal Oswal Financial Services, who says there's some positive bounce back from recent lows. He says valuations are now quite reasonable for key indices. With earnings season about to begin, near-term market movement will be led by earnings, especially IT and financials. He also says tech earnings are expected to be weaker sequentially. He's positive on financials and consumption stocks and has moved consumption to overweight in their model portfolio. Gautam says within consumption, they like Metro Shoes, ITC, Titan. They've added Vedant Fashions and Indian Hotels to their portfolio. He says they've also added Godrej Properties to their model portfolio. So very interesting. Gautam Duggad was actually cautious for a while, and now he's turned optimistic. Of course, the market has also recovered. So as they say, markets make opinions. But, they've added a couple of new stocks in their model portfolio as well that we mentioned.
No, absolutely. We'll discuss more on that in a while from now. Venugopal Garre of Bernstein also has a view. He says a peaking of rates or even visibility is positive for equities. He says in the near term, macro trends help them reiterate their rebound call for India equities in a broadly bearish phase globally. He goes on to add India's underperformance to emerging markets over the last 6 months will narrow with this rebound, which is the key call. Their view is that macro recovery from the lows and then a stay in a band for more extended period as global adjustments and absence of a shock will be much longer this time.
All right, in fact, Venugopal Garre will be with us on the show today at 9:30 a.m. to discuss in detail their rebound call for India. So that's the second view this morning. It's not even 8:30 this morning, and there's a big rebound call that has come through for the Indian markets. But for the rupee, let's get you some money market views as well. B. Prasanna of ICICI Bank says better than expected US labor data supported the dollar index, which was under pressure owing to a softer PMI data last week. He says while the approaching peak in the rate hike cycle favors a weak dollar outlook in the medium term, next inflation print will determine the short term. He adds the rupee is expected to trade with an appreciation bias, with the RBI smoothening volatility in the range of 81.40 to 82.40 for this week.
Well, on bonds, B. Prasanna says global yields that rallied initially last week on softer economic numbers retraced marginally post the strong US labor data. Back home, he says the MPC announced a relatively dovish pause, surprising the majority of market participants, which led to a sharp rally. He expects markets to trade positively amid steepening bias. He expects the 10-year benchmark bond yield to remain in a range of between 7.1 to 7.3%.
Well, we have a lot of stock-specific action, and we'll get to that in just a bit in our special Top 10 segment. But for the time being, let's run you through the list that we're looking at. IGL, MGL, GAIL, Tata Motors, Titan, Credit Access, Grameen, Shobha, as well as Godrej Properties. All of them will be reacting to positive news flow, while on the flip side, you have ONGC and Adani Wilmar that will be reacting to negative news flow.
All right,